All right, let's talk taxes. Specifically, we're going to demystify that final, sometimes tricky part of your tax return. Our goal today? To turn what feels like a really complex calculation into a simple, step-by-step journey that actually makes sense. Let's get right into it.
Okay, so you've done the heavy lifting, right? You've tallied up your salary, you've figured out your business profits, you know your capital gains. But what about all the other stuff? You know, that little bit of prize money you won, or the interest piling up in your savings account. Where does all that fit in? Let's figure that out.
So here is our roadmap for today. First, we're going to solve what I call the final income puzzle. Then we'll zoom in on specifics like winnings, gifts, and interest. After that, we'll open up your tax-saving toolkit. And finally, we'll walk through the whole thing with a clear 4-step calculation.
All right, let's start with the first piece of this puzzle. We need to understand where the tax code puts all that miscellaneous income, the stuff that doesn't neatly fit into those big, obvious categories.
And here it is. The official name is income from other sources. Honestly, just think of it as the tax system's catch-all bucket. If you've earned some money and it isn't salary or from your house or business or a capital gain, well, it almost certainly lands right here. It's the residuary category, basically for everything left over.
And you know, the criteria for what falls into this bucket are actually super simple. For money to be taxed under other sources, it just has to pass 3 little tests. 1, it has to actually be income. 2, it can't be something the law says is totally exempt. And 3, it isn't already being taxed somewhere else. That's it. Pretty logical, right?
Okay, so what kind of money are we actually talking about here? Let's get into some real-world examples that you might have come across yourself. First up, we've got casual income. This is for any time you got a little lucky. Maybe you won the lottery, or you're great at card games, or you even won something from online gaming. The tax code sees all of this as a very specific kind of income, and it has its own special rules. And check out how differently the system treats these two. A lottery win gets hit with a flat 30% tax. No ifs, ands, or buts, no deductions. But a cash gift from a friend, that's only taxable if it's over 50,000 rupees in a year. And hey, gifts from close relatives or for your wedding are totally exempt. Worlds apart. Now, beyond those big one-time events, this catch-all category also covers more regular, everyday earnings. We're talking about the dividends you might get from stocks you own, the interest your savings account is quietly generating, and even things like a family pension. It all falls under income from other sources.
Okay, so we've talked about all the money coming in. Now for the really good part. Let's talk about the powerful, completely legal tools you have to lower the amount of income you actually pay tax on.
This is such an important idea to get your head around. Deductions are not some sneaky loophole you found. Not at all. They are official provisions put into the tax code on purpose to encourage us to do things like save for retirement or get health insurance. They're a reward, really. So this brings us to 2 absolutely crucial terms: gross total income, or GTI, and total income. Here's how it works. First, you add up everything you've earned from all sources. That's your GTI. Then, you use your tax-saving toolkit, those deductions, to subtract from that amount. What's left over? That's your total income. And that's the number your tax is actually based on. And if we're talking deductions, this number is probably the most famous one in all of Indian tax law. Section 80C. This one section alone lets you chop off up to 1 log 50,000 rupees from your taxable income just for doing things you might already be doing, like contributing to your PF or paying for life insurance. And ATC is just the start. It's like the anchor of your toolkit. You've also got ADD for your medical insurance premiums, ADE if you're paying off an education loan, and even ADTTA, which lets you deduct up to 10,000 rupees of the interest you earned from your savings account. Pretty cool, huh? All right, we have all the pieces of our puzzle. We have all your income from every possible source, and we have your full toolkit of deductions. So now let's put it all together and see how the final tax bill actually gets calculated. It really boils down to this simple 4-step logic. Step 1, you calculate your income under each of those 5 main heads. Step 2, you add it all up to get your gross total income. Step 3, you subtract all those awesome deductions we talked about to find your final total income. And then, step 4, you apply the tax rates to that number. But hold on, we're not quite at the finish line. After you calculate that base tax, there's a final layer to add. If your income is very high, a surcharge might apply. But for everyone, there's a mandatory health and education cess. It's calculated as 4% of your tax amount, and it gets added right on top. So let's quickly recap the big picture.
The system first gathers up everything you earn into one big pot. That's your gross total income. Then it hands you a toolkit of deductions to shrink that pot. The smaller amount that's left is your total income, and that's what your final tax bill is based on. Simple as that.
You see, knowing how this calculation works isn't just about filing your taxes correctly. It's about empowerment. It lets you see it clear as day how your financial choices, from how you save to where you invest, can directly shape your final tax bill. So the real question is, what's your next move?